Welcome to All About Money on HKIBC. I'm Chloe Fong. After a 5-session losing streak in the worst slump since February, the Hong Kong stock market rebounded on Tuesday on optimism of more stimulus measures and as Beijing tried to stop the yuan's slide. But geopolitical risks still loom as the short-lived Russian rebellion serves as a cautionary tale for investors and across the Pacific Ocean. Sino-US relations remain tepid. So as we enter the second half of 2023, what can we expect? Let's turn to Kenny Wen, Head of Investment Strategy at KGI Asia. So Kenny, welcome to our show.
Thank you for having me.
And first, let's talk about the recent recovery from the Hong Kong stock markets. And we've seen some rally yesterday. How would you comment on the performance so far? And also, if we could summarize the first half of 2023, what is your comment on this?
For the first half, very simple, disappointed. Very disappointed. Maybe we can use two angles to further explain the issue. First of all, if we compare with other countries, other stock markets, as you all know, we are far lagging behind. Especially if we compare with US technology stocks, Nvidia, they performed so well. But our Tencent, our Alibaba, whoa. So you know that our performance is lagging behind. And also, if we compare with the expectation, it's also disappointing because as we remember at the end of last year, China relaxed some prevention of the COVID-19 policy. And then we have a high hope of the economic rebound and also for the stock market. Don't forget that at the end of January, Hang Seng Index reached at around 22,700. So in that time, not everyone, most people are relatively bullish. But now it's talking about 19,000, 20,000. So no matter we compare with the expectation or compare with the counterparties, our peers, it's really disappointed. And even though for the recent few days we see a rebound, but just a range trading, we're still lagging behind. I think there's several reasons. First of all, externally, we can remember that at the end of March, we have the banking crisis in US and Europe. So that will hurt our investment sentiment, right? Okay. Secondly, we have a linked exchange rate with US. So with the US keep raising their interest rate, we get hurt. If we refer to our HIBOR, that is our internal rate, it's still going up around 5%. So it's the externally, but these factors can't explain why we underperform, right? So I would say, just like I mentioned before, it's talking about the China economy. The market have a high hope on the economic rebound, but you can see that especially in April or May, those economic data is worse than market forecast. Maybe I can share a short story. I remember that during at the end of March, we having the corporate result announcement period. So I met with several listed company managers. They told me that the recovery of China economy is not as, I'm not saying that they're very bad, but it's not as good as they thought. And then around at the end of April, the central government announced the Q1 GDP growth actually is better than forecast, 4.5. Yeah. And then I saw several financial company, they revised upward that this year GDP forecast to maybe 6% or 6 point something. In that time, I'm less positive with them because I got the message directly from those managers. The recovery is not as good as we think. And then in May, we know that those retail sales, fixed asset investment, also the industrial production data are all worse than market forecasts. And interesting point is, for the past 2 weeks, I saw them cutting their forecast from 6 point something to 5 point something. So I think 5 point something is more realistic. So one of the key points is because the economic rebound is worse than forecast. That's why we are lagging behind. And if you remember, we can say it this way: if we divide the total stock market into two groups, one is with AI, one is without AI. So you can see that US, you can see Japan, Taiwan, Korea, they are in the AI group. So they outperform. But for Hong Kong, of course, we can explain in more detail. I will treat it as non-AI. So we do not, we have a less robust economic growth in China. We have some volatility in US, and we do not have the AI investment theme. That's why we underperform. That's what I think for the first half of this year.
But thinking about AI's development in China still, we have like AI giant like since time, isn't it?
Yes.
So,
but don't forget, it is losing money. And Baidu may be another AI-related stocks, but the stock price is very volatile. I would say if we want to be success in AI development, first of all, chips is very important. Then we subject to some restriction from US, and maybe in coming few days they will announce another round of restriction on chips. Okay,
right.
This first one. In second one is related to regulation. It seems that China have a little bit tightened regulation on AI
development.
Yeah, so without these two factors, I think for China stock to enjoy the AI rally, it's a little bit difficult. If you ask any investor, they will agree AI is a good investment theme. But why don't they go for US? So that they will, we see for the past few years, from office, even Hong Kong people, their interest on Hong Kong stock is dropping down. So they will go for US stock, and for the past few months, they will go for Japan stock markets.
I mean, having the bigger freedom is apparently some positive note as well, but even in the Western economies, they're also calling for regulations as well. So it's kind of like a tough balancing act on the AI development. But speaking of the second half of this year, as this week we're wrapping up the H1 and now we're entering H2, what do you think about the outlook then? Do you think the Hong Kong stock market will continue the downward trend, or do you see maybe we could see some reversal later on?
We think there will be some reversal because, let me put it this way, our HSI target for the second half is 22,100. I don't know that it is aggressive or not for you. Anyway, our calculation is very simple. Our forecast on Hang Seng Index EPS, earnings per share, is 2,085 Hong Kong dollars. And then we assume its PE ratio will rebound to the 5-year average, that is 10.6 times. So we combine these two factors. EPS is 20,000 something, and then 10.6 times PE. We will get the answer will be 22,100. That is our target. I would say for the corporate earnings is relatively stable and resilient. The key part will be the valuations, whether we can expand the valuation to the 5-year average will be the key point. But given that there is interest rate differential from US and China, we see the RMB keep dropping, maybe a little bit challenging to achieve the 10.6 times PE. But anyway, we expect in coming 1 month, we will see a series of stimulus policy from China. So the liquidity, the economic outlook, and also the market sentiment should be a little bit improved. So our target will be 22,100 for second half of this year. We do have a serious study on the past 10 years. We found out that if the first quarter GDP is very worse, and then at the end of April, in that meeting, they will change their tone. They will focus on striking to boost up the economy. Then the whole China will move in the same way. Then we'll be very positive on the stock markets. But the key point or the hurdle is this year, for the Q1, our GDP is 4.5. Actually, it's better than market forecast. And also for Q2, because of the base effect, you remember that last year, second quarter in Shanghai, what happened?
The lockdowns.
Exactly. So even though I said the recovery is less robust than our forecast, but if compare the data year on year, then we still have a very good result for second quarter. People is looking for 7% for the second quarter year on year growth. So you combine it together. First half, we can have 5 or 6 GDP growth, which is much higher than the objective around 5%. So I would say we are not at the critical point. So that's why in the April meeting, they're still talking about we focus on quantitative and also qualitative transformation, something like that. But in the July one, I think they will change their tone, and then they will launch out a series of government policy that should be have a positive impact on the market sentiment.
All right, before we go,
Yeah.
I want to talk about the Sino-US relations as well, because this is also another major concern that
Yes.
caused the jitters among the markets. Now, with a possibility, Bloomberg is reporting that
Yeah.
Janet Yellen
Yes.
could visit China in early July, that's next month. So do you think with her visit, we could see some positive signs between Sino-US relations and maybe particularly on the economic or trade side?
Maybe in short term, because with conversation is better than without conversation. So that is a good development. But I won't be too optimistic on the Sino-China relationships. Don't forget, U.S. will have their president election next year, and Taiwan as well.
Right.
Unfortunately, maybe because of misunderstanding, for U.S. citizens, they generally holding a not very good impression on China. So because of the election, I do think that China relationship will be a key topics. So I won't be too positive on that. And I think for the Joe Biden administration, their strategy is a little bit different compared with Donald Trump.
Actually, Biden is tougher than Trump, isn't it?
Yes, but they will using different strategy on different topics. We name it as 3C strategies. For environmental protection, they are cooperation. For technology, they're competition. For human rights, freedom, they're containment. So it's a little bit different from Donald Trump. But anyway, I think, yes, I agree, it's quite tough. And I don't think that the U.S.-China relationship can be solved in near future. So I will say, not for coming months, for coming years, this will be one of the uncertainties, and somehow someday will hit up and then affect the stock market. But anyway, I would say for this moment, the key target or investor focus will be U.S. monetary policy, U.S. economy. For the relationship with China may not be the top priority. So we will take a wait and see approach to see how things going up.
All right, thank you very much for your thoughts. Kenny will take a short break for now, but coming up next, we'll continue our discussions on the financial markets outlook, so do stay tuned. Welcome back to All About Money on HKIBC. I'm Chloe Feng. Joining us today is Kenny Wen, Head of Investment Strategy at KGI Asia. So Kenny, welcome to our show.
Thank you.
Earlier we have talked about Hong Kong stock market performance, and now globally there's also some intensity that is ongoing, especially in Russia. We've seen the stunning performance over the weekend with the Russian rebellion. But the markets didn't so far have some instant reactions because the markets was closed over the weekend when the issue happened.
Yes.
But as we move on to the second half of the year, would you say there could be some ripple effects from this event that could spread into the second half of the year? What would be the key areas that you'll be keeping a close eye on?
Okay. Frankly speaking, we are not really know what's happening in Russia. And also the issue changes so fast. So we see that the financial market do not react very aggressively, including US dollar, including US Treasury yield. But I think even though it seems a little bit settled down, but I think we need to ask two more questions or two issues we need to follow it. First of all is, what will the impact on the Russia and Ukraine war? So someone argue that Putin maybe need to focus on the internal issue first. So there will be some slowdown, or at least it won't get worse from the Ukraine war. That will be good for the global financial market and global economy, right? And the other issue I want to point out that we need to follow up what the Western country policy on Russia. Because even though Putin is a little bit aggressive, but he stepped up, he already in his space more than 10, 20 years. So relatively predictable. if within a civil war, there's a new people to come up, they are unpredictable. I think for Western countries, for those leaders, unpredictable, unstable will be even worse, especially for the stock markets. So I think with the predictable Putin, maybe he stay in his seat, maybe more benefit for the whole world. So I think we need to focus on how the policy regulation, the restriction on the Russia change in the future. But anyway, I think in this time, the Russia war may not be the key focus on the country. We will follow up and keep a close eye to see what happens in future.
After more uncertainties or let's say instabilities, many are saying like the safe haven assets, for example, the US dollar or the Japanese yen could be again favored. Do you think this trend would also continue? But let's not forget about the recessionary fears in the US economies and also the rate development as well. Yeah.
Okay. For maybe I can talk about the US economy first. Our base case scenario is for second half of this year, US can avoid the recession, but it's only avoid, not it only delayed it. So we still think that next year for the first half, US may enter a mild recession. Okay, but and then we can talk about the interest rate. In this moment, we think that they will still raise interest rate in July, but it's a tough call because as they announced that there's a data-dependent policy. So until next time Federal Reserve meeting, we still have three very important data. First of all is the PCE at the end of June. And then at the early of July, we have the employment report, including non-farm payroll. And then at the mid of July, we still have another round of CPI. So without knowing these three important data, it's really tough to say it will raise interest rate or not. But I do think that given the current inflation environment and the labor market situation, they may have one or two interest rate hike in the second half, maybe July and September. But anyway, I think for England, for Europe, they're even more hawkish. So for the US, I don't think US dollar can have a very strong rally, maybe just range trading at the current level.
Let's talk about tech sector rally,
Yeah, sure.
because this is apparently the major outperformer in H1, and especially when you're talking about the tech-heavy Nasdaq Composite Index, it has risen 28% year to date, putting on pace for its best first half since 1983. And the Nasdaq 100 has fared even better, rising almost 35% year to date. Do you think this tech rally momentum would also continue as we move on to the second half of the year?
Yes, but the volatility will increase. First of all, we can explain why the tech sector will outperform. I think they're driven by several reasons. First of all is the market is looking for skip or the end of policy, the interest rate hike. So usually interest rate hike will be negative for growth stocks because their future earnings, when they discount into current the value, will be have a lower value given a higher discount rate, right? So the interest rate stabilize will be the positive factors. And then if we focus on the past 2 quarters corporate earnings, most of the tech company, their corporate earnings is quite good, including NVIDIA. They're also saying that the second quarter, the order is quite good. So for the interest rate environment, and then we talk about the what we call the corporate earnings, and then we mentioned the AI investment theme. So and also if we focus on US, in absolute term, maybe GDP growth only 1 or 2% is worse than China. But always we compare with the expectation. In the beginning of this year, everyone saying that US will have recession this year, but seems that is not the case. So their GDP, their economy is more resilient than forecast, and then the interest rate is near the end of the cycle, and then we have a very good investment theme AI. So that's why they performed so well. I still think that driven by the corporate earnings and the AI theme, this investment theme, even though it's relatively expensive, still have a mid to long way to go. But in the middle, the volatility will have will quite volatile, and we don't be surprised we see some correction. So for the tech company, we will take a bottom fish approach. When they have a correction, maybe driven by no matter reasons, we can buy it, but don't chase the rally.
All right. And moving on to the China's AI sector, for example, Baidu, it has this week released the results saying that its version of ChatGPT is actually doing better than ChatGPT, right? It's Baidu, the chatbots called ErnieBot. So with this kind of like positive, let's say, results being released, do you think this company could also faring better and with more capitals being poured into this company as well?
Okay, even though they said they're better than ChatGPT, but frankly speaking, if you ask investors, maybe just not everyone will believe this saying. So we can see that, and also for Baidu, is not only driven by the AI, it also have another business segment. So I will say, if you really like AI, given the current investment sentiment in Hong Kong, China, maybe Baidu may not be the perfect vehicle if you want to capture the AI investment theme. Why don't we go to US stocks? So for me, Baidu is just a change in the trading range, and volatility is very, very, very high. So the only way we can do is when it has bad news, when the stock price drop down, we can bottom fish, and then when it bounces back, we may lock in some of the profit. So range trading will be the strategy rather than buy and hold strategy.
The EV sector is now also on a downward trend, especially with now, for example, Goldman Sachs downgrading Tesla stock after its 105% year-to-date surge. Do you think this kind of like momentum will also continue in China? And what about the momentum, for example, in India? Do you think the India's EV sector would also do better compared with China? Because now, seemingly, China's domestic market is kind of saturated, isn't it?
Okay, first of all, for Tesla, even though some financial institutions may revise their outlook just because the stock price rallied a lot. So in terms of the valuation, maybe a little bit stretched or demanding. So that's why they reduced the outlook. But they are not saying that Tesla is not good. They are not saying that the future development is not good. It's not the case. Especially in China, a very different. We see a divergent situation. For BYD or several the makers is quite good, and we see that because driven by the policy, I still think that EV car in China still have a very strong growth. Especially they are going out from China now. You can see that in Europe or in other countries, they are still receiving order from other countries. So I still think the EV car we have our advantage, but we need to pay attention to which company. Some of them still losing money, may not be so good. So I think the EV sector is one of our topics for long term, but we need to very selective, focus on specific stocks. That will be the key to be successful investment in EV sector in China. And regarding India, is a very difficult question to answer. We see that now India seems work very closely with US, but I will say for manufacturing, China still enjoy the edge. But just maybe some US company want to diversify the risk. They will ask for the manufacturing factory to move out from China, but mainly still using China. So it's just a diversification of risk. So Vietnam, maybe India can enjoy a little bit of the whole apple. But the main apple is still eaten by China. With the infrastructure, if we compare the infrastructure, I think India and China is a huge differences. So given the labor market, the infrastructure, I do think that China still enjoying the global manufacturing factory status.
Its edge.
Yes.
All right. Thank you very much for your thoughts, Kenny. So that's a wrap for today. That's Kenny Wen, Head of Investment Strategy at KGI Asia. And thank you for watching All About Money. We'll be back next Sunday night at 8:30 p.m. So until the next time, please take care.